on. This is the last week in Mortgage Today, by the way. I'm Rich Swerbinsky with the Mortgage Collaborative, and our weekly walkthrough, all the latest, greatest, all the latest news headlines, developments with the mortgage industry. And each week, I am pleased to be joined by one of our lender members as my co-host. And this week, back in the co-pilot seat, the Chief Financial Officer of Homestar Financial Corp, Stacy Mohr. Stace, great to see you.
Great to see you, Rich. Always a pleasure to be here.
Let's go ahead and get into it. And a couple people in the chat noticed my Christmas decorations are going at the end there. I'm keeping the Christmas lights up though. Those, anybody knows me knows those stay up year round. So still some festivity in the background in our Zoom world here. But let's go ahead and get into it, Stace. And a very excellent jobs report this past Friday. Big bearing on our industry. We'll get into the mechanics of that momentarily here. But in general, it was about as positive of an employment report as you can get. 200,000 jobs were expected, and we got 517,000. Within that, wage growth was relatively muted. All in all, precisely what the Federal Reserve is looking for, a robust a job market, but not stoking inflation and preventing, some of the needed correction there to get our economy and also our industry kind of back on track. Start with your initial thoughts on the jobs report last week, its impact on rates and all that good stuff as we get into the second month of 23 here.
Sure. Yeah, you're right that was an impressive jobs report. Totally unexpected for it to be that big, especially, the news headlines are big companies doing big layoffs, right? Everyone expecting economic conditions to worsen. So they're reducing their staff, and yet you see another 500,000 jobs created, record low unemployment. It seems like the two can't coexist. But what I really saw in terms of mortgage rates was this was the data that the markets needed to see in order to hear what Powell's been saying, which is we're going higher for longer, because the market expectations that you could see in the pricing did not match what the Fed was saying. And we've seen after Powell spoke on Thursday, still weren't really aligned. After the jobs report, more aligned. And then even yesterday wasn't a great day for rates either. More of that moving in line with what the Fed is saying we're going to do. And that's good because someone was wrong, right? Either the Fed was wrong or the markets were wrong. And now we're seeing a little bit more cohesiveness there. Not good for rates, but we had to get some correction there.
It's interesting. You make so many good points there. I want to dig deeper into, but really what the markets are saying right now is like, we don't believe you, Jerome Powell, at least the immediate reactions, because last week you did not get the reaction you would have, and into this week, the reaction you would have expected. And the market reaction is completely different from the words coming out of the mouth of the Fed chairman, which is like, hey, we're not out of the woods. We're going to keep freaking hammering rates and raising rates, and we're going to keep fighting this. It's a long haul. And the market's like, we're out of it.
Yeah, we're cutting rates in a few months.
Right. But you did have a little bit of that fear and loathing on the mortgage bond market this week kind of creep back in. And, because there is more optimism priced into the markets, which is really converse from what we saw last year. The markets were pricing in fear and loathing, beyond reason. And now we're kind of seeing a little bit the opposite, though, it seems like.
Yeah, a little bit. We're not aligned yet, but we're closer.
We're getting there. So other big news that broke recently, we've been talking since the news broke a week and a half or so ago about the revised FHFA Fannie Freddie loan level price adjustment / delivery fee charts. Certainly not what the market was looking for or expecting there. We're kind of waiting to see what MBA would say. They made an initial comment and then a more coherent statement. I believe it was yesterday morning, really calling on FHFA to re-examine these changes and the impacts of them. You're right in the middle of all this, Stace. Your thoughts on all these developments?
Yeah, so the initial reaction from the MBA was, hey, this doesn't look too good. We're going to dig in some more. And the letter that they sent to FHFA touched on that said, hey, we're in an affordability crunch and you're making it cost more for good borrowers to get loans. But the most important piece, in my opinion, that they were really pressing on was the DTI adjuster. And I've heard both sides of the arguments that this is totally doable and that this is completely not doable. And the truth in some ways is that both are right. Income for some borrowers is a straightforward thing, but for a lot of borrowers, dialing in an income number that's acceptable to the GSEs is more art than science. And you've got to really have someone who's an expert in that. And, you know, loan officers are going to have to get better at getting to that number sooner in the process to get that pricing right. But we're also encouraging borrowers to go online and help themselves and fill out those applications themselves. And then you're going to lock them in based on that? That's not helpful to the borrower to get it wrong there and change the pricing on them. And then going over such a finite line like 40%, if you're 39.9 or 40.1, that's such a small amount of income change or debt change that really throws you into it can be a loop of pricing adjustments, right? You know, today we tweak this number and your pricing gets worse, and tomorrow we tweak it back and your pricing gets better. And is that really a valid change circumstance? And there's so many messy parts to that I really agree with the MBA that this isn't the right way to approach it. And hopefully FHFA hears us, and you know, MBA has offered to get a panel of lenders together to really explain the details. You know, that's what we really need, is a partnership to talk with us ahead of time about what we're proposing, so we can say, we understand your goal, let's find a reasonable way to get there. Because this DTI adjustment has just made things really ugly.
Very well put. The DTI adjuster, the increased fees in some of the buckets, it just makes it tougher to price people accurately at the point of sale, like you mentioned. One other question I have for you, I've never brought this up with any guests, but just the nature of employment today in America. So much more side hustle, people earning side money here, doing this, doing that. You know, obviously, you know, just generally speaking, side hustle money harder to verify and use as part of the picture than stable long time employment. Talk, if you can. This was not in our show notes script, so I'm totally putting on the on the spot here, but just the general complexity of that. You mentioned a couple different times the importance of loan officers, of, you know, taking a complete app and identifying all the information up front. Seems just always important, but probably even more important today than ever. No?
Yeah. Now you're getting into, you know, self-employed complexities. I mean, that's always been a difficult piece of underwriting loans. It's not a black and white area at all. There's a lot of income calculators out there, and different agencies or different investors want to see it different ways. And so it's not as simple as give me your 1099. There's a lot more that goes into it. So it really is. If we go down this route, it's a big area of education for those who talk to borrowers up front, for the loan officers, even for the processors collecting the right pieces of documentation up front. And then we can, as an industry, we can probably provide our loan originators with better tools to gather that information up front. But again, we've been, as an industry, going the opposite direction of the self-help, you know, online, enter the information yourself. That's great when you can verify income through the work number and things like that. But this gig economy, this new generation of different types of employment doesn't fit that simple box.
You know, you mentioned credit costs. Another big issue with the lenders right now, just the increase in credit costs in general. You know, and now you kind of have a situation where you could, in theory, this is going to create more credit pulls and more credit work, you know, during the life cycle of a loan. All purchase deals tougher to do. You got some new complexities in the delivery fee system. How have you guys adjusted to the credit cost increases? Anything creative you're doing there? You've always been one of our go-tos in the network on kind of the cap markets and the finance side. So welcome any perspective you have there. Just general cost cutting and some of the increased costs that lenders are facing as they head into, you know, largely an uncertain year.
Yeah, these cost increases have been a shock to the system, really significant increases. I don't know that we're doing anything terribly creative on the credit side. We're definitely pushing soft pulls. That's becoming more and more of a tool that we realize we need to use. It was, some people use it and some people didn't, but with the cost increases, we have to go that route and really try and minimize that cost, because that's something that every loan you don't close, you eat that cost. And there's no way to absorb that except for increasing the cost for all borrowers, right? I mean, you were talking about last week, the margins. We don't have extra room to just absorb increased credit report costs. It just, at the end of the day, it costs all borrowers more. I mean, I could see a scenario where, with the cost that these credit reports are coming in at, that you start charging them up front like you do an appraisal. But if your competitors don't do that, you can't do that, right? That's that's the hard part. We either all do it or we don't. And I don't see some of the bigger names willing to start doing that. So that means we're all stuck with the model that we have now, which again, it's just increased costs for everybody because it goes into overhead.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by Chief Financial Officer for Homestar Financial, Stacy Mohr. And Stacy, yeah, you mentioned the increased credit costs, increased costs in general. I think in the past, when the government has maybe passed through costs through the GSEs, Rob Krisman likes to talk frequently on our Friday show about the 10 basis point, the G fee thing that was put in like a decade ago, that was like part of some spending bill and still is in place today. I think largely like the way the DC views are, and they make so much money, they're in the there's not a lot of sympathy for the mortgage industry during tough times, which I never understood that, because the tough times in our industry are brutal. Can the good times be good? Yes, but if you look at like even out like an average 10-year period, our industry doesn't deserve to have that reputation, in my opinion. And maybe we need to do a better job of, just as an industry, talking about that a little more. But where I was going with that is, in the past, when they've done, lender will absorb it, or kind of, but now it's going to go right to the borrower, right? Lenders can't take any more hits. Any cost increase that is levied in any form or fashion is going to go directly to people purchasing homes.
100%. The competition is so fierce that we've squeezed as tight as we can. There's no room to absorb anything else.
Yeah, you can't take any more hits, and maybe that a little lost. I mean, I get that, these delivery fees, it's not, I don't like people that just like complain, and there's always a flip side to everything. There's always two sides to every story. And the other side to this delivery fee story is like, if you want to decrease the delivery fees for 620 to 679 based on, the performance history of that bucket, it's costly to do so. There's a reason those delivery fees are higher. If you reduce them, Treasury is, and I think that's why we have what we have. They're like, hey, we got to get that money from somewhere else. I thought it was the increased fees on the cash outs and the second homes from a year ago. Definitely, that was just an appetizer. So,
yeah, the agencies have their marching orders, their duty to serve, right? They've got these goals that they need to meet. And I think that they are subsidizing, the affordable housing for certain areas of the market that need more help with, increased costs for those that don't fall into those buckets. But I do believe one of their goals is to get private investors to come in and move into that space. So if they keep squeezing the good quality borrowers, eventually someone will come in and say, I can do that cheaper. I'm willing to take that risk for less. And we'll see more entrance into the market. I do believe that's one of their goals. Just if we don't have those private entrants, it gets more and more painful until if and when that time comes.
what do you see as the impact, if these delivery fees go into place? I think it's May 1. Over 680 business that goes to FHA, do you anticipate a lot of that business moving over to FHA just because of the straight, better option for the borrower? Do you see that happening or no?
Not with MIP the way that it is now. Now, there's talks about MIP cuts at some point coming.
Whatever happened to that? I mean,
It's not a
that was,
matter
I
of
thought that
if,
was the,
but when, but we don't know when. However, I don't think those are going to be drastic enough to really open that up as much either. I think FHA is still a need to product rather than a want to product.
yeah, that's a good point. What else is going on in the news, Stacy? A story we were bouncing back and forth this week. Chat GPT, obviously big news in the world and America, and pretty, interesting AI technology that us in the Mohr, we've seen some of this stuff, obviously, in our industry, and now the greater world is kind of seeing the power of AI. The story that became newsworthy was one done by CNN that is, basically saying this could really change the face of not the mortgage industry, but it's more about the real estate industry, realtors, the way they list properties, but certainly has the potential to bleed over into our industry as well. Your thoughts on that story this week?
Yeah, I was having a conversation about that with our chief digital officer here, who's had a chance to play around with it. And unfortunately, he planted the little bug in my ear that our kids will start using this for their homework. So now I have that to worry about. But
There's already enough. I have 4 teenagers. I cannot tell you the amount of cheating already opportunities that exist for high school students. So it's another one. We wonder, we're falling behind all these other countries academically. I'm experiencing firsthand why these last couple of years. So
if you got any parenting tips on that, Rich, I'll take those offline. But
no good ones.
This Chat GPT has amazing potential for a lot of industries, including real estate. Our chief digital officer, in his experience, it's not anything super powerful today, but absolutely that potential is there, and it's something to be watched. It has a lot of great potential. I heard today that Google has their competitive product coming out, Baron, I think it is. So they've got some competition, which is good. I mean, two different platforms competing to be the best in this AI is only going to make them stronger. But I think it's going to be a topic of conversation in the real estate industry this year. 2023 is probably going to be really big for this. And I think the potential or the opportunities on it here in February and at the end of the year in December are going to be drastically different. We're going to see a lot of growth in that area.
I think you're right. Our industry, it's probably not where I thought it would be at this point if you would ask me like 3 or 4 years ago, but it's clearly emerging. Some AI companies that doing some things on moving of files, underwriting, and other kind of loan manufacturing parts of the process, but still it's kinks for sure. And I bought a house like a couple of years ago, 1.5 years, and I remember going through the process, which I had not been in a long time. And I remember just coming away thinking in the lender I used one of these really high-end point of sales, made the application process so easy and seamless and intuitive, like asking the right next question. But then you submit the app. And I was really surprised, it was a fairly easy file. The amount of interaction I still had with a processor back and forth after I submitted everything pretty thoroughly. In my mind, that was one maybe area where AI can really come in. It seems like they're, and again, quality of application, quality of all that, but it seems like there's some opportunity from like, the great point of sale apps to, okay, the files underwritten, like that part of the process for AI to further impact our industry.
Yeah. We're using Candor as our technology there. And just since I was introduced to it a 1.5 years ago, I've seen big improvements in it. There's investment there, there's growth in the technology there, and that's going to build on each other, and we should see a lot of improvement. But you're right, we aren't as far along as I would have expected us to be either.
Yeah, and that's through a company I was alluding to, Candor, a good partner at TMC, and I mean, that's how we learn about companies like that. We listen to lenders like you that are having good experiences with them. We go in, we do our own due diligence and try to forge partnership agreements with the companies to get our members better terms. That's kind of one of the things we do. And so had our ear to the ground on that space. And yeah, we're starting to see some new exciting things emerge. So more to come on that front. Other news this week, not really directly specific to the mortgage industry, but affects us, is just the whole work from home and work remote thing. The big news story was that commercial office vacancies hit 50% nationally or I'm sorry, vacant buildings were over 50% full for the first time since the pandemic. So kind of a seminal moment, and, kind of led to a lot of news stories and discussion around kind of the future of remote work. If you look at most industries and nationally, and our network is the same. We just did a survey of our members a few weeks ago on this topic, and it was essentially 50% some sort of hybrid, 20% almost all in person, 25% almost all remote. And that's kind of where our industry is settled. Where is Homestar, and where do you see just the future, I guess, of remote work in the mortgage industry as it relates to those percentages and trends?
Yeah, so I fall right into that hybrid model. I work from home 2-3 days a week, in the office 2 or 3 days a week. But we have a lot of people that work solely from home. Our in-person staff, we used to have 2 buildings. Now we only have 1. It's shrunk dramatically. And when we do go into the office, I kind of laugh because we'll stumble trying to get something onto the conference room monitor when it's so easy to just share your screen from home. And it's like, let's just go home. It's easier to do it that way.
Efficiency, yeah. We got this work from home thing down now. It is efficient.
But, there are definitely industries that being in person is much more important than others. And you are hearing more companies ask employees to start coming back into the office. And I am not surprised when everyone shifted to at home in 2020. They talked about give it a couple years, and then we'll start to see what the future is really going to look like, because that was temporary. So it got us to all experience it, and then start figuring out what works for your company and what doesn't, because we are finding out that there are some challenges to working in the office that are overcome by the same technology of working from home. Even though I've got my laptop in the conference room at the office, I don't have my multiple monitors, and it's just not as efficient for me. But this is going to affect our industry more from the terms of the real estate, in being very market specific. But where you're lending, if you're more rural and all of a sudden your buyers dry up because people are moving back to the city, that can really impact things. I think right now is a good time for it to happen, because we have such a housing shortage that housing's just needed. Someone's going to move there, but once we get that sort of evened out and we've got enough housing stock for the amount of demand that we have, you might start seeing some downward price pressure on the rural markets if this trend continues of bringing more people back into the office.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by the Chief Financial Officer of Homestar Financial Corp, Stacy Mohr. Stacy, the big IMBs continue to be in the news, and now it's UWM can't stay out of the news. Ishbia is buying the Suns, and you got its rivalry with Rocket. My team, the Cavs, is owned by Rocket CEO Dan Gilbert. Ishbia just bought the Suns. The NBA owners just voted. They voted 29-0 to approve the sale. Rocket abstained, then came out the next day and said, "Hey, any of you brokers getting sued by UWM, we'll pay your legal fees." It never goes away. Do you find, as CFO of an IMB, not that size, but nice size, do you find it comical? Like, how do you view, the constant news headlines of the biggest IMB top people?
Yeah, I mean, I do get some laughs out of it, that's for sure. I was really happy to see Rocket do that, because I am in the same boat as a lot of people in saying that what UWM did was unfair, and it's being a poor sport. You need to compete on your merits and not prevent people from taking their business elsewhere. So I was glad to see that they're saying, hey, we're going to help you guys if you're stuck in this situation from this being this heavy-handed move. We're gonna give you some leverage. They're going to use their strength to help the smaller guys. And yeah, the broker model is our competition, but I am all for a fair playing field. And the IMB model has its merits, and happy to stand by it and say we've got a great model. And the broker model fits some people as well, and there's room enough for both of us.
In the chat, I ignored the one about my clock being an hour fast. Evidently, with the stockings covering it, I missed daylight savings. I'm an hour fast, so which terrified me actually earlier today when I thought I was late for the show. And then also a question about the heavy-handed move that UWM pulled. This was about a year ago, it was early last year, when they basically said, if you do business with UWM, you can't do business with Rocket. And they made brokers sign this attestation statement, and they've taken some to court that have signed it and just still sold the Rocket. So now Rocket's saying, hey, we'll pay your legal bills if you're one. Never in a million years did I think any company or any human could make people sympathize for Rocket Mortgage. But
you're right.
I mean, really, honestly, Rocket has got to be sitting there laughing their asses off, because their statement was something it was a smart statement. It was about the you can't do business with Rocket thing. And they're like, it's one of the worst things we've ever seen happen to the industry, and really defies the entire spirit of the mortgage broker, which is choice and option. So
yeah, they're calling it their bully shield. I mean, that name made me laugh. But I like that they took it a step further, because UWM did this against both Rocket and Fairway. And Rocket said, we'll provide this protection for you, even if it's because you're giving loans to Fairway. It's not just their self-preservation. It's saying, we don't agree with the way that this was handled in our industry. So I thought it was a good move.
Friends at Fairway, like when they included Fairway in that last year, Fairway had like a tiny little wholesale channel, and they got a huge lift off that. It cracks me up. But as the world turns with our friends over at UWM. So in general, last thing to take us home for the week, the general competitive landscape would welcome your perspective on this. Obviously a lot of the big IMBs trying to grow and scale. And, if you're a real small independent mortgage bank without a ton of capital, it can be a tough situation. You get some of the big banks that are kind of getting out of retail mortgage or correspondent mortgage. And I just would love to hear your thoughts on just the general competitive landscape as we get into 2023.
Sure. I mean, that's, if you don't like change, if you don't like challenge, you're in the wrong industry. I've been in this industry for 16 years. I've seen good times and bad times. And no matter what size you are, it's difficult. It's difficult for the big guys right now too. But it's definitely very challenging if you're a smaller or medium-sized IMB. It's a tough time, but this is a season, and seasons change, and you gotta find your strengths to stick it out. But there's better times coming.
Very well said. A nice optimistic tone to take us home. And Stacy, really, really appreciate you being on the show this week. Always do such a good job, and you will certainly be asked back to co-host again. So I really, really appreciate it.
Thank you, Rich.
And to our attendees, thanks as always for joining us. We're here every Tuesday at 2 p.m. Eastern. My clock says it's 3 p.m. Eastern, but it's really 2 p.m. Eastern for the last week in Mortgage Today. You can find us on YouTube, find us on podcasts, search TMC Connect, Apple, Spotify, wherever you get your podcasts. And until next Tuesday, have a great rest of the week, everyone. Take care. Bye, Stace.
Bye.